The market had gotten crushed in October. So, we're in a way oversold position. So anything that's perceived as positive is going to send the market higher.
I'm not knocking the tweet, but the market rose the last 2 days without a tweet. And so we're up less than we were the last 2 days. I'm sure it was a flavoring on top.
Right.
Either way, let's talk about what really probably moved the market, and that is bond yields. We talk about flash crashes. You call it a flash jump in yields,
Right.
15% gain in the 10-year
Right.
in a month.
Right.
It's settled down. How
Right.
much of that is factoring into what we're seeing the last couple of days?
Well, I think that is factoring. Listen, the bond yields had come way down when the market was still under pressure, right? We went from 3.27% back to almost 3.08, and the market was still kind of under pressure. I think now the market is once again kind of starting to focus on the fundamentals. We're almost through earnings season. It wants to focus on midterm elections and then once again fundamentals. We're also coming in, as Dom said, into kind of a seasonally strong market, November, December, end of the year. And so I also think the fact that we were so oversold and the action that we saw in October was so volatile that the market, there's lots of bargains out there and there's plenty of people with money to buy.
Yeah, Rick, related to the lower bond yields, we're seeing a sharply weaker dollar today. It's having its worst day, I think, since back in June. Mix of weak economic data, trade tensions. What levels are you watching?
I still think in the macro, the dollar index looks good, but there's always going to be setbacks. I, in particular, think the almost 7/8 down today, big give back, but it's still, we had two closes above 97, and now we're about a quarter cent above 96. Probably some pretty good support. My interpretation is as we go into tomorrow's number, that's most likely why you're seeing a little bit of a backup in yields to the downside and the dollar index retreat. There's a lot riding on this, and I know many say, well, inflationary pressures seem to be moderated even though the labor market's tight, unemployment rates, the lowest in 49 years. I disagree. I think any given first Friday of the month, whether it's wages, hours worked, that we're very close to making everybody a bit nervous if things snug up a bit. And I think that in particular has big implications for possibly 2019 Fed policy. So the dollar index has a lot vested in this number, as do interest rates. I think after the number, we'll see a much more true picture of the dollar. And I always urge everyone to pay very close attention to those average hourly earnings, especially the year-over-year numbers. I think they'll be very significant in how the dollar index rebounds, should it rebound tomorrow.
Erik Ristuben, let's play a game. I want you to fill in the blank on this statement. Over the next 2 months, the most important factor for the stock market continuing to move higher is what?
Well, I think actually things remaining roughly the same. Look, we view this as a correction that's likely to bounce back. But I think it's lasting longer than the prior corrections that we've seen for the very reason the market is actually beginning to understand recessionary risks in, say, 2020 are rising. So I think in the short term, the market just wants stability. It wants earnings to keep coming through. It wants the trade tension not to show meaningful impacts on GDP growth on a global basis. In the longer run, as we move into 2019, we think the market's going to continually, increasingly looking at recessionary risk building, a lot of it having to do with that low unemployment rate that Rick just mentioned, and potentially the pressures that brings to bear on monetary policy, with the shape of the yield curve already in a warning sign for the markets in general.
So earnings continue to be a big theme here, Kenny. There's always a debate going into Apple about how big of a deal it is for the overall market and the economy, but especially against this backdrop.
Right.
It's such a key part of ETFs and the overall indexes.
I think it's going to be a big part just because of what we've just gone through, what's happened in tech, what's kind of happened to the broader market. Apple is one of those names that changes the world. Everyone's got a piece of it, whether you own it directly, whether you own it in a mutual fund, whether you own it in an ETF. So everyone's kind of connected to it. But look, I don't think Tim Cook's going to disappoint. I think the earnings are going to come out. They're going to be excellent tonight, and the stock's going to move higher, and then therefore that's going to give stability once again, not only the tech sector, but I think it'll also help calm the broader market down.